Hey everybody, thanks for joining us today and welcome to episode 8 of Coffee with Cosmo. Today we'll be talking about everything DeFi. What is it? Why is it exciting? What does it mean? And today we're joined by Kyle Sonlin, venture partner with Cosmo, good friend of mine and CEO of the Paxum protocol. Kyle, great to be with you today. Could you do a little intro for us?
Yeah, thanks, Jack, for having me. And shout out to the Cosmo team for putting together some great content and hosting me today. My name is Kyle Sonlin. I'm from Philadelphia in the Northeast, just outside in Doylestown. And then I've been in Miami for the last decade, building in the tech scene here. About 7 years ago, I launched a business in the tokenized security space called Security Token Market alongside a business partner of mine, Herwig Konings. We built that business over the course of that time. And now I run a portfolio of close to a dozen companies that I've invested in or started with the product that I've been focused on most recently, Paxum protocol, which is a blockchain focused on connecting interchain liquidity pools, aka how do we drive liquidity into tokenized assets, which has been the biggest problem in the industry since I've been involved. So I certainly have my hands in a lot of pots, both inside and outside of Web3 and inside of the venture space.
Definitely a lot of very exciting stuff going on there. So excited to dive into that. Just to start us off, let's give a little overview for people. So what is DeFi and how does it differ from traditional systems?
Yeah, so I think there's certainly a few different ways to answer that depending on which context you have. DeFi traditionally spun out of the cryptocurrency space where they really had no regulatory component to solve for, which means that their main focus was how do we automate as much as possible and how do we create a system that really doesn't rely on any manual oversight, whether that's from a person, from a group of people, or from a centralized entity or company. Now, when we look at what DeFi means to the actual financial system, it means, I think, a little bit of a different definition than what we see in cryptocurrency, but a lot of the traditional themes do remain the same. How do we automate as much as possible is still the question here. How do we build semi-permissioned networks that can track the transparency of the markets and build a more efficient process for capital formation and transfer in a way that doesn't require quite as much manual oversight from all the different intermediaries and maybe removing some of those intermediaries from the process.
Definitely, really important point there that we've discussed on several of these episodes here with Coffee with Cosmo is that whole concept of removing middlemen, automating processes, and just creating more efficient systems. And that's really what DeFi is all around. And a big part of that is there's a lot of actual inefficiencies in our current financial markets that this technology is really out there to solve. So what are some of those problems that we're seeing in traditional finance, whether it's settlement, middlemen, fees? What's the big issue that DeFi is out here to solve?
So the biggest issue that DeFi is here to solve, and no matter what anybody tells you with respect to any of those intermediary processes, at the bottom of the funnel, at the end of the chain, the most important thing that DeFi is solving is it's reducing the cost of capital. And so all of these different pieces along the way all add up to how expensive is it for me to transact or complete a transaction. So whether that's raising capital, whether that's transferring capital from two different parties, it all comes down to who's taking fees in the middle and how can we reduce that as much as possible. Now, where do those fees come from? They may come from actual people that need to get paid in order to do it. It may come from companies that have licensure that take a cut of the process. It also can come from time, where time is money, right? And so the longer that a transaction takes, the more expensive it is, both in terms of the resources required, as well as the opportunity cost of each one of those dollars. And then finally, number 4 is that opportunity cost piece, not only in terms of time, but just in terms of opening new business avenues by automating things, by offering new products and services that wouldn't traditionally be able to be solved with the traditional system, i.e. like what we're seeing from Broadridge, who is doing not only a larger business by settling a lot of their transactions on chain, but they're actually being able to offer same day money market transactions where traditionally they were just doing overnight only because that was what they were able to do. So we're seeing them being able to offer not only better qualities of services at a cheaper price, but also new products and services because of the automated capacity.
Definitely. That's some key points there. Better services, better prices, and that's kind of enabled by the technology here. A use case that everyone really understands with blockchain is just basic transactions. So that's, using the peer-to-peer networks to remove the middlemen, make that more efficient, remove the costs. But with DeFi, we're starting to see these platforms sort of leverage the software element of it to create more complicated automated systems here. So just, this is meant to be a very educational series here. So what type of technologies, whether it's, cryptography, blockchain, smart contracts, let's just go into those a bit and how they enable DeFi.
Sure. Well, the first one that is the underlying stack that is the most important piece is actually having digital dollars. So whether that's using stable coins or, as we've seen with JP Morgan and other large banks, they use tokenized deposits. So they essentially have $1 in deposits or $1 in their account, and they create a digital certificate that represents that dollar. And so by tracking all of that money, they're now able to move that much easier without actually having to move the dollar from a particular bank account. Perhaps they move that dollar into an escrow account, and then that individual transactional token can then be moved between anybody in between, and we can now have a more efficient process. And so the first thing that we need to do is get the liquidity on chain into the tokenized economy, because that is one of the most difficult parts. Anybody that's tried to send money into Coinbase or send money off of a centralized exchange will know it can take days, it can take weeks. It can certainly be very difficult from a licensure process with money transmitter laws. So getting the money into the tokenized transactional system now allows us to interface and play with all of the automated systems that are benefited from another technology that you described, which is smart contracts. So with smart contracts, basically what we're doing is building a series of if-then statements that allow us to transact. So essentially, if we think about what does JP Morgan do? Well, we could build a really large standard operating procedure where they already have it in their internal documents, and then build code that can self-execute all of those things. So if we have the dollars that are already on chain and we have the infrastructure that we've been able to build from an automated component, we need one final thing, and that is blockchain. And the reason that we need blockchain is that your automated system is only as good as the data that you feed it. So we need to be able to be sure that the data that we're giving into our systems is verified, is secured with cryptography, as you mentioned, on the particular blockchain that you're using. So if you have a database that tracks the transactional data, the intermediaries that are involved on chain, you have your automation that happens on chain via smart contracts, and then your money is also on chain through your tokenized dollars or deposits. Now you can build a financial services provider fully in an automated system. And then you can layer in the compliance and some of the individual jurisdictional requirements. Now you have a fully functioning financial services company or bank.
Yeah, a lot to take in there. So the first sort of fundamental technology is this whole concept of dollars or currency on the blockchain.
Right.
And that's what we call stable coins. And this isn't some sort of abstract concept or idea. In the last 30 days alone, we've actually seen about $2.5 trillion worth of transactions using stable coins. The leaders there being USDC and USDT.
Sure.
So you get dollars on chain. They start to enjoy the benefits of immediate settlement, transparency, composability with all these systems. And then from there, we can use these smart contracts that embed those if-then statements, as you put it, and build more complicated systems such as, exchanges, lending and borrowing, insurance, trading. So let's talk a little bit more about those specific use cases and how you see those playing out and developing.
So the first few use cases that we see that exist on the market today all revolve around that first layer of having dollars on chain. And so we see a lot of money market funds and that style of product really catching on. One reason is because the actual money market lending market is hot right now. Private credit is hot. There's a lot of banks that need liquidity. And so being able to move the capital from one bank to another is a really strong use case because it's high frequency, it's tokenized deposits to just move cash from one place to another. You also may have interjurisdictional or cross-country or cross around the world transactions, right? So you're going to have a lot of these intermediary layers that if we can skip a lot of that by
And
me
fees.
sending my cash right to your wallet, we can avoid a lot of moving, because a lot of times when you're a bank, you might move if you're a small credit union, for example, you might move cash from multiple different banking intermediaries to get from one side to the other. Instead, we can just jump that really quickly. So we see it on that side. On the other side, from a products perspective, you see a lot of successful money market funds, whether that's the Biddle product launched by BlackRock, whether that's the Benji product launched by Franklin Templeton. And I think Wisdom Tree has some products as well. We also have seen Ondo Finance, Maple Finance, Solid State. There's probably a dozen tokenized money market funds, if not more. The reason why is because all of these treasuries of these large banks and institutions have a lot of tokenized cash that they're sitting on, and they want to get yield on that, right? You're not just leaving your cash in your savings account, you're putting it in a credit fund or a high yield savings account. Tokenized issuers want to be able to do the same thing with their tokenized dollars. And as you mentioned, the market cap for tokenized stablecoins is close to $200 billion today, which means that that's $200 billion worth of assets that should be able to get yield the same way that would if it was traditional dollars. So we're seeing those things coming to market quickly. We're also seeing a lot of tokenized commodities to represent all of the commodities markets that are relatively antiquated compared to, let's say, the stock market. And so those markets that are a little bit older, that are also cross-jurisdictional, that are also very important to track these assets and where they are from a provenance perspective, it's pretty important to start bringing those things on chain so that everyone has full transparency.
Definitely. And so at the center of all this, like we keep saying, is this tokenized money. It's bringing dollars on chain. And, I don't think it can really be understated, the opportunity both for people that are using the currency, just using dollars, but then also potentially the US itself, as all these stable coins are backed by actual US dollars and treasury bills. So, despite the reluctance for sort of the US to put in proper regulation, there can actually be some significant global demand for dollars just from these technologies and from the adoption of these DeFi systems. So on that, what do you see as the future of DeFi? How is it already improving our financial systems? And then if you want, mix that into what's going on with Paxum and the opportunity there.
Sure. Well, I definitely think that with a global economic system, sharing liquidity is really, really important, and it's incredibly profitable. And so when we look at the SWIFT network, which is one of the more traditional banking infrastructure components that was built in the 80s, right? We're now in 2024, which means that it's at least 40 years old, if not more. And think about how much technology has changed in the last 40 years, let alone where we're headed in the future with high frequency trading, with everything going on, not only within our local country here in the United States, but also internationally and what that means. So unlocking liquidity and being able to connect a lot of these things together is really important. And that's what we've been trying to solve with Paxum. In the same analogy as tokenized deposits, where we have all of these different banks that have dollars in their savings account that can't really communicate with each other. We also have the same problem on all these different blockchains. If you've tokenized your liquidity pool and you have a fully trading ecosystem on Stellar, it's really hard to communicate that across chain to Avalanche or to Ethereum or to Solana, despite the fact that a lot of that capital may just be sitting there unused. And then on the other side, you may have other chains that have real assets that an issuer would want to market make for, or an LP would want to market make for, that can access those capital components. So a lot of what Paxum's trying to do is connect all of those different liquidity pools on all those different blockchains to be able to build that global intra-connected network of cash flow so that we can build that healthy global economic system and support any different blockchain or any different asset that falls into the ecosystem.
Yeah, I think a great theme that you were talking about there is the whole concept of upgrading and improving our financial system. So you see Coinbase, their whole campaign right now is on upgrading the financial system. You see Larry Fink at BlackRock saying, step one is ETFs, step two is the tokenization of every asset,
Right.
really driving us into this digital sort of blockchain-enabled future here. So, despite that, it can enable some use cases, these permissionless technologies that the US might not want to support. There's also massive opportunities to upgrade just our normal traditional system and make it built on better technology, better systems with more efficient and cheaper transactions.
Yeah, I think the biggest thing with DeFi is that really to see that benefit that we're describing, the entire life cycle of the asset needs to be on chain. So from origination at the beginning of the transaction all the way to the end. And in order to recognize the real benefit, we need to see that whole process come on chain. And that starts with the dollars that we participate with, that is the assets in the middle, and the different intermediaries integrated throughout. That's the most important part of building this infrastructure and starting small and building those closed loop systems that then we can begin to upgrade and expand upon by proving the concept. You know, you look at a company like Figure that does home equity lines of credit, HELOCs on chain. They see 1 to 200 basis points of savings on those transactions. And now they are the largest non-bank home equity line of credit lender in the entire United States. I think it's even globally. So like they're crushing it. They're proving this use case. And we're starting to now see 10 years later, a lot of these different companies really starting to prove that concept. And as we talked about, it all comes down to cost of capital. Anybody can say there's a lot of efficiencies. What does that actually mean at the end of the day? Was it cheaper for you to do this transaction using these on-chain systems than if you were to do it manually? And once that answer begins to be resoundingly yes, like we're starting to see, that's when you're really going to continue to see that larger adoption.
Definitely. Thank you for taking us through all that, Kyle. You know, DeFi is certainly growing at a rapid pace. It's recently climbed back over $200 million of total value locked. The derivative space went from about 50 billion to over 300 billion just in the past year. So we're seeing some serious adoption, some great enablement and improvements on technology. So thank you, Kyle, for joining us today. We're coming up on the time here. And thank you for everyone that listened. You know, we appreciate it, and we'll be back on next week for more Coffee with COSIMO.
Major shout out to the COSIMO team. I'm happy to work with you guys closely, and thanks for giving me the opportunity.
Awesome. Thanks again, Kyle.
Talk soon.